Hey everyone, welcome back to the channel. So I'm sure you've all heard the headlines about unemployment skyrocketing nearly 15% and the market being up 30% from its lows in March. How is this possible? It just makes no sense, right? Well, I think this paradox can be explained by a few unique details about this very weird market. So before we get into the video, please drop a like if you like videos explaining the market action and subscribe to the channel for more stock market related analysis. So how can the market be up 30% from its lows while unemployment is still up 15% simultaneously? It just doesn't make sense, right? Well, my first observation is that people are looking at the market performance since its low in March instead of looking at how it's fared since its high in February when unemployment was reaching records of its own, but in a good way. Instead, I think people should be looking at how far the market has fallen from its highs around 3,400 for the S&P 500, which now sits around 2,800 to 2,900. In fact, if you consider how far the market has fallen from its high to its close on Tuesday, the market is down over 15% from its February high. Pretty close to the unemployment figures that we got last month. And when the market hit its low in March, it was down around 36% from its highs, much more than the increase in the unemployment figure. Should the stock market mirror percent increases or decreases in the unemployment figure to the exact percent at all times? No, of course not. But I think the general sentiment is right to question how the market can continue to recover despite increasingly bad news about the increasing unemployment figures that are surely higher than that reported for the month of April. If businesses are having to lay off employees, they must be hurting, right? Yes, but only to an extent because it is the small and medium-sized businesses which employ just under half of the United States workforce that are feeling the worst and having to close their doors as a result. Many of these businesses lack an online presence and are therefore unable to generate any revenue that can be used to pay bills, including employee salaries. And while the government created programs to help these businesses continue, the programs for these businesses weren't near large enough to support them maintaining employment levels for an extended period of time. But surely if businesses were hurting, we would see that reflected more in the stock market, right? Well, not necessarily. And I think we are seeing that pain in the markets, but it is just underneath the surface. Let me explain. Mega cap technology makes up the top 5 stocks in the S&P 500. Microsoft, Apple, Amazon, Google, and Facebook. And these companies represent businesses that you probably use products or services from on a daily basis. So it makes sense why they're worth so much. These companies all exist in some capacity online, and in some cases benefit from an online commerce and business environment by taking share from competitors that solely exist with a physical presence. These mega cap tech companies, which are doing decently and in some cases are thriving, show consistency, which investors seek right now, dragging up the indices disproportionately while the greater concentration of struggling businesses that make up a much smaller portion of the index face continued pressure. These 5 businesses make up more than 18% of the S&P 500 index, and because they have been rising so rapidly from their lows, they have been providing support and lift to the markets. In fact, these companies are all down less than 10% from their highs, with Microsoft leading the pack, just down a small 3% from its high as of midday on Tuesday. If you look at these companies' recent earnings reports, you'll see them mention that some of their business lines are struggling, but overall, there was positivity about their futures. These companies also produce solid earnings for the current environment, proving that their business models provide consistency in both good and bad times. And because of this consistency, they are able to reinvest heavily back into their businesses to get further ahead, taking greater share in their respective industries. And here we just talked about the S&P 500. If you look at the technology and biotech heavy NASDAQ, you'll see that the index is actually up year to date. How can one market be up during these difficult times? Well, the NASDAQ has greater concentration of businesses surviving and thriving in this environment, and people are looking to growth and safety. Who wants to invest in a Macy's or an American Airlines, for example, that both have to raise a ton of debt to survive when you can invest in an Amazon that produces so much cash that they can decide to invest $4 billion into their business on safety measures in the workplace for their employees? In fact, this explains the 6-day upstreak for the NASDAQ running into Tuesday. People simply want their money invested in these companies. And consider that the market was the most oversold it has been in decades at its March low. The market had dropped over 30% in less than 1 month. Now that is terrifying. That rapid of a decline has never been seen before, and it's hard to get more negative when everyone is panicking. Because the market was so oversold and there were no sellers left to sell, only buyers remained to sweep up the remaining shares at a discount. And like a coiled spring, the market has been bouncing higher ever since. The market tries to look ahead to the future. Typically, people assume 6 to 12 months and predicts how well business will be doing at that time, or at least tries to. The recent health events and the resulting downfall in the economy was something the market did not predict and had to rapidly revalue companies that suddenly made a fraction of what they did before, hence the rapid decline. Now that news of an economic reopening has been surfacing, the market is now trying to determine where we will be in 6 to 12 months. Any negative news that changes that outlook is bad and causes the market to go lower like we've been doing in recent days. And though this can work most of the time, it is the unpredictable events that the market tries to predict that often don't match with expectations in the end. And then there's the low interest rates. With continued flows into the bond markets and even larger flows guaranteed from the Fed, a lot of risk in the stock market has been removed. With the Fed actively buying bonds, this all but guarantees that low interest rates will continue to exist into the near future. And because low interest returns are not very attractive, people seek higher returns elsewhere, i.e., the stock market, where you can purchase strong companies with high yields and may even see capital appreciation along the way. Interest rates are like gravity on stocks, weighing them down. So the lower the interest rates, the better stocks will outperform. This historically low rate environment has provided a cushion to the market, allowing it to bounce, and is just one more reason that it has been able to rally so much off its lows. So is this market rally sustainable? It's possible, but the companies doing well in this environment are going to have to demonstrate remarkably better profits to justify their valuations. Or else either more good news about a vaccine has to come in the near term, or strength from the underperforming stocks has to appear from renewed strength in their businesses upon reopening. The rollover in the market over the last couple days may be proof that this rally is not sustainable. Generally, I think companies are going to invest more conservatively over the next year, and slowing investment means less economic growth, which in turn slows the growth of companies. Keep in mind that we can go lower, but patience and the focus on finding long-term value will prove the best strategy in this environment. So, What do you think about the paradox between Wall Street and Main Street right now? Do you think it makes sense? And is it justifiable? And where do you think the market goes from here over the next 6 months? Comment your thoughts below. And after doing that, be sure to like the video and subscribe to the channel if you haven't already so you can see more in-depth stock market analysis in the future. Until then, see you next time.